Hey, welcome to the podcast, everybody. Thanks for joining me. Appreciate it on this Monday afternoon. I hope your weekend was great. The weather here in South Texas has been unbelievable, and now I know why people, I was going to say live in California, but visit California. I don't know if I'd want to live there, but it is a nice place to visit. And right now, Texas is a nice place to visit. But of course, we got people listening and watching all over the world. Thank you for that. And look, the stock market had another good day today. Out of the gates, second quarter has begun. The Dow Jones Industrials up 52.5 points, 0.4%. Gave back some of its gains. I'll show you that in just a minute. The utilities were up about 0.5%. You can see all down the way there. The S&P 500 at 1418, up 10 points. As we go through it here, financials, telecoms, insurance, pretty much everything across the board was up. Russell 2000 was up 1.2%. Semiconductors did have a weak day today. You can see it there. One of the only red things on the screen, down fractionally. So you can see the S&P pretty much right out of the gate had a pretty nice gain going. It was actually down really early this morning. There was some Chinese manufacturing data that came out a little mixed, but off we went straight up. Kind of paused during probably the afternoon lunch hour. Went up even stronger. I think the Dow Jones was up about 80 at one point, and then you can see we sold off at the end of the day. Does that show some fatigue for this market? Probably in the short run. I mean, we thought towards the end of the quarter here that we would get some type of continued lift, simply because people wanted to show good stuff on their books, and there's window dressing. There's all these end of the quarter things that tend to help the market out if it's been a good quarter, which it was. So it wasn't going to give it back. We saw a 100-point sell-off, 70, 80-point sell-off in the Dow a few days ago, get erased intraday, and those losses were erased. So, but here we are at the beginning of the quarter. Some people think that we will still have money flowing in because we're not to May yet for the seasonality. Sell in May and go away. We do have tax returns and refunds coming back, so that money tends to go into the market. And seasonally, it's just a decent time for the market. So that could play a part for the first couple of weeks of April. But nevertheless, the stock market still, is going up, and it's grinding higher. I mean, a 50-point gain on the Dow, 1/3%. S&P 500 up 10, NASDAQ up 27, but still pushing higher. But it is, it is pulling back at least at the end of the day here. So it did show some sort of fatigue potentially. So the bulls and bears will certainly be watching that. Now this is what really got the markets going this morning. We saw the China non-manufacturing PMI, which is this number. You can see going all the way back to 2007, came out at 48.4. Now 48.4 is below that bogey line of 50, which is contraction. Above 50 is expansion. But there's something important to point out here, which is look how many times we've gone below 50. You can see it happened in 2010, happened in 11, here we are in 12. So it's not necessarily to say, China's fallen off a cliff here, but it's something we need to notice because since June of last year, we've been making lower and lower highs. But when you look at this, it almost looks like a cyclical picture more than anything. But really the manufacturing part of this is really what the market's been concerned about, because remember, last month we had a couple of things happen. First of all, China lowered their GDP growth target. Last year it was about 8%. This year they're saying they're going to target 7.5%. Of course, those are very, very high numbers. Any country would love to have that. But nevertheless, it is falling. And last week, China released their HSBC flash manufacturing PMI number, mouthful, and it was 48.1, down from 49.6. And this was the fifth month in a row it had fallen. So it is there's a big, probably the most, more so than the stock market being overvalued or undervalued, probably the biggest tug of war right now has to do with China and whether they are successfully choosing, or let's say successfully choosing to slow their growth down, kind of throttle it back, or are they simply going through a hard landing that they can't control and everything's slowing down. last month, J.P. Morgan's chief Asian analyst comes out and he says, if you look at the Chinese data, you should stop debating about a hard landing. Car sales are down, cement production is down, steel production is down, construction stocks are down. It's not a debate anymore, it's a fact. And so when you look at those types of things, you go, wow, I have to take pause here, because if China does slow down, there's no way the rest of the world's going to continue to grow. And so that's still a debate going on, but that's why last night there was some mixed signals from some of these Chinese pieces of data coming out, and the market seemed to be worried about it this morning, and then as usual, as of late, shrugged it off, and up we go. But anyways, one of the things that I'm looking at currently is the relationship between the S&P 500 and commodities. And what you can see from the chart here is the S&P continues to make new highs, commodities not so much. And you would say, well, what's the big deal there? Well, they've been very correlated going all the way back to 2009. So this is something to be worried about if you're a bull, because, again, these divergences, they tend to resolve themselves. Now, obviously, commodities could go racing back up, or the S&P could come crashing back down. There's two ways that this could converge, or one moves sideways, the other one, meets it up. But again, it's something to watch, because places like the Economic Cycle Research Institute continue to point towards a recession and saying we're still going to have one. It should happen in the second or third quarter of this year. It's inevitable. Then you have people on the other side of the fence saying it's not happening, unemployment's coming down, everything's great. And, I must admit, I would have thought a recession, when we talked about last August and September and how bad things were then, I would have said we'd be in a recession by now. And maybe we are. Again, we don't find these things out till after the fact. But the point is that things are more improved than they were last summer. Even as bad as they are right now, there are several metrics that are better. Now, on the other hand, there's a lot of things that are just downright worse. And we could go through all those. I'm not going to bore you with them, but there is this definite ledger that we have to look at. How many bad things there are, how many good things there are. The only thing we can do is monitor what the stock market is telling us and looking at all the internals. Because if we simply concentrate on the fundamentals, we either will probably be out of the market completely, not participating at all. And I think a better way to do this is a more balanced approach. As I've mentioned for months, income, taking profits from there. And again, we've talked about this. You have been penalized for taking profits in just about anything, and that's a sign of a strong market. But the thing is, I simply have to still not throw caution to the wind, because there are too many things to worry about. So from that perspective, enjoy the rally, but don't forget where your sell spots are. Don't forget to get the income, and also don't have some things that aren't correlated to the market. You need to have some things that are not correlated to the market. I'm not sure if I said that correctly, but don't forget to have securities not correlated to the market. There it is. So be careful of that, but this is one thing that I'm watching, is this divergence, because it could play a part in the next few weeks. Okay, I want to talk about interest rates for a minute. Let's switch gears here from stocks to bonds and rates, which obviously go hand in hand at times. And before I move on, I did want to mention that last chart I showed you. When I say the commodities, that's the commodity-related index. Those are the stocks of commodities. So that's where the divergence is. But again, it could be a leading indicator of things to come. So it's not necessarily commodity prices themselves. So here's interest rates. These are 10-year treasuries, and we know 2 weeks ago there was a big spike, and it was talked about that, hey, this is the beginning of the end. This is it. The low rates are gone. And now what we've seen is rates have actually settled back in again, and they've come down. I think one thing, and I've got the 50-day moving average on here, but one thing to consider is that rates paused kind of at this level, but we still, if you're looking to short rates, I think there is a line right here, and we could see the Treasuries rates couldn't really get above that, and I'll move it down just to make you people that are very, very specific happier. But here we are. So we bang up against the line, finally break through, hit this one, we come back down. If you're going to take a shot at shorting treasuries, this is probably the place to do it now. And of course, if we go on up and break through this other level, which is about 2.4%, then you're good to go. And of course, you can use TBT. There's other ETFs to use, but I think there's still a question whether we're making the turn or not. I don't think we're making the turn in the big picture, and the reason I say that is because I think the economy is weaker than people believe, or at least the media believes. Maybe you don't believe it's strong, but the media tends to think it's stronger than I think it really is. So that should keep rates down. In addition, any type of stock market correction would push people back into treasuries. And then lastly, who's the biggest buyer out there of treasuries? It's the Fed. So if rates go up, they're going to come right back in and push them back down. We've already heard about QE3. That's part of the reason the stock market's been rallying. So I don't necessarily see rates spiking up here, although I do think there are trades from time to time. But in the big picture, is this thing going to turn the corner? I mean, when we zoom out over a 5-year period here, we're still heading down. And obviously we're scraping the bottom from a perspective of, if you think of interest rates kind of like a clock, and you figure 20% or 18% back in the day, or 15% back in the early 1980s, here we are down at 1.8, 2%, and people are panicking because we've moved from 1.8 to 2.2, 2.3%. Imagine if we went up to 3, 4%. So you must be careful about the types of things you own based on low rates, because at some point it will turn. I just don't think it's going to be now. But should you hedge at times? Should you play TBT? Absolutely. I'm not making a big bet on rates staying low or going up right now, but certainly look technically that they were turning the corner. But here we are, and I'll zoom in over the last 6 months, and you can see, again, there's that spike. That was it. Short bonds, everything's going straight up. Bonds are going to collapse, and now rates have come back to where they were. So let's keep an eye on that, but that's one thing that's had the markets, at least the bond market, nervous. So this is a picture that I sent out to my clients in my client newsletter this past week. And what you see here is, I keep getting asked, is this 2007, or things about to fall off a cliff? And of course, we don't know what the next 6 months or a year will hold. This is a probabilities game, and what we do is we assess the risk, and then we adjust our portfolios accordingly. In 2007, you notice here I've got two lines. The red and green line is simply the advanced decline line. And for those that don't know what that is, it's the number of stocks going up versus the number of stocks going down. And generally speaking, and again, I have to go back to 100 years of data, generally speaking, when bull markets become bear markets, this line is one of the indicators that gives you a warning. It will tend to fall 4 to 6 months prior to the stock market falling. And as you can see on the left in the yellow, that's exactly what it did. The S&P, I have the little line there showing it was in the blue, was making new highs. And the advanced decline had been falling for probably 4 to 6 months, like I said, in advance. And finally, the stock market did crack, and then, of course, down we went. Now, it made a low in 2009, coincidentally, meaning at the same time as the stock market. But what we're seeing now, if we go over to the right of the screen, is we're seeing a confirmation of the rally. The advanced decline is at new highs, or near new highs. And so, again, this is one thing. When we look at the big blender of indicators, we put all the stuff in there and we come up with an assessment on where we think the market's going or the risks associated with it. This is one thing that's on the positive side that makes us go, hey, you know what? This rally could last 4 to 6 months longer, because even if it made a high today, and then we perhaps may have 4 to 6 months to go. So this is one of those foreshadowing indicators that says, hey, things are falling apart. Because remember, in a bull market, when it's becoming a bear market, you will start to see stock by stock start to go down, and then it's sector by sector starts to fall apart. Well, right now, what do we have? We have financials doing well. We have the staples, consumer staples doing well. We have retail doing well. Technologies doing well. REITs are doing well. It's pretty broad-based, and so that's something for the bulls. And again, that doesn't mean we go out there and buy a bunch of stocks and say, well, this one indicator says things are good. No, it's just one piece of the puzzle, and I point it out to you because it's something we need to be watching, because, again, we go back to the last very severe bear market. and there were plenty of warning signs. What we have seen in 2010 and 2011, when the stock market had those big drops in the summertime, was basically corrections. There wasn't much warning to those. The flash crash, there was some warning. There were several indicators in April that said, hey, a big correction may be coming, but it wasn't a sign that the bull market was ending. Last summer, look, we went down 20% from the high to the low, so you could argue that that was a bear market. But most people say, no, it was a correction in a bull market from March of 2009 until now. And it makes more sense that it was a correction simply because there were no warning signs of any deterioration prior to that. Remember, in the early part of 2011, the stock market was kind of humming along. It wasn't doing great, but it was okay. And then, pow, July, August, September come, and the volatility picks up, and the stock market falls dramatically. And we're not seeing that, now we're not seeing those warning signs. So, again, and I've been saying this, if you have too much cash, and I just wrote a blog piece a week or two ago, one way to handle it is to average in over time and then use pullbacks to accelerate the buying. The only way you wouldn't want to do that is if you start to see the selling intensify and you start to see real supply come onto the market. We're not seeing that right now. The down days are generally that the buyers are simply saying, you know what, maybe I can get a better deal and I'm going to stop buying temporarily. And that's totally different than what we saw in 07 and 08. So that's very encouraging. But one indicator, again, going back to this picture that I'm watching, is the number of stocks going up versus the ones going down. Simple. And it's since 2007. You can see what we have here, and we do not have the warning sign yet. It may come, but right now it's confirming the rally. Now we'll just conclude today. I just want to show you the S&P. This is the 50-day moving average and the 200-day moving average. And one thing that we have to constantly do is say, how do we become better at making money in this market? There's a couple of things that we should do. Number one is to look back where we came from and say, if I was to do things differently, what would I do? The first thing that I would do differently, because I have been more conservative than perhaps I should have been, given the fact that the market is showing this persistent uptrend. But with all the macro situation going on over in Europe and the political unrest and all of these things going, geopolitical unrest, I should say, all of this stuff going on, and coming off of last, August, September, October of a very extremely volatile, scary market, it's very difficult to change your tune and say, okay, everything's fine now. But the thing we have to do is we have to go back and look and say, what would I have done differently? And one of the things that I would have done differently is right in here, and I think we pointed on the podcast, we broke out of, first of all, I had trouble getting through the 200-day moving average, right? And it finally broke through. So that was one buy spot. Another buy spot, of course, was when the 50 crossed the 200. That was another bullish situation. But again, what we see now, of course, is where the stock market is currently, and it just has this persistent move up. But so now we have to say, okay, well, we need to zoom out here and take a look at it from a little broader perspective. So the most obvious thing, well, there's a couple of things, and you can't see it on my screen. I'm not going to bring it up, but the volume's been decreasing quite a bit lately. We've had insider selling. We've had mutual fund outflow, so people are pulling money out of equity funds. That could be viewed as a contrarian indicator, and I think part of the reason we're seeing the insider selling is because stocks have run up, and it's natural for executives to take money off the table. Now, we have seen stuff that's a little curious, like Toll Brothers executives coming on TV saying, hey, things are much better than we thought they would be. They're fantastic. And then they go and sell the next few days. So if things were so great, I'm not sure why they would be running out there selling their own stock. But when we look at the stock market from a little bit longer perspective, you got to start looking at these highs back in 07 and 08, which is in the 1550 range or so. We're at 1418. So, we could start to make a push for that, but I think the first logical spot is very close to where we were. The reason I point this out is because the stock market had trouble going below these spots here. And once it broke through, and then it came back up, and you can see, boom, it hit it again, and that's where we failed. So now we're up against it again. So it's more than likely that we would see some type of pullback, and then if this is for real, then we would go up and test the stock market. Kind of like the pattern we've had here. Remember, the pattern we've had is down, up, down, up. Could we have some kind of a pullback coming right now and then a push forward? And maybe it's the summer doldrums again. Here we are in April. Maybe we start in the next few months. It's hard to say. Obviously, I don't have the crystal ball. But the point is, this is the kind of stuff technicians are looking at, and we're very extended in the short term. But there are still places to go, even on some of these down days. That's one thing that we're seeing is on down days, it's not everything across the board going down. You can still pick your battles and find things that are bucking the trend and going in the right direction. So, again, be careful in the short run. As usual, this market is stretched, but so far we're still seeing a bunch of stuff confirming the rally, not saying this thing is coming to an end. But we have this trajectory that you can see, which has gone straight up to kind of this 18, 14, 20 range. So this is something that big macro guys are watching, because it was a kind of a floor back in 07, and then we cracked through it, and then we couldn't get back above it in 08, and that was the beginning to the end, so to speak. And here we are, back up against it right now. All right, guys, have a wonderful day. Don't forget, twitter.com/Karl Eggerss, eggerscapital.com, redesigned site, Google+, plus Karl Eggerss, all that stuff. Anyways, enjoy all of that, and thank you for the emails. Appreciate it, and we'll talk soon, guys.